Hey there everyone, here's a recap of Cameron's CLE speech. My name is Sarah and I will relay all the tax tips and some fun tax cases to you that Cameron went over in his speech. The first portion will be focused on the new tax rules under the Trump tax, focusing on individual tax rules, the qualified business income deduction, and then a bit of accounting and estates and trust rules. Basically, you're going to zone out for the first part of this lecture. However, the second portion will be focused on dumb things some tax preparers have done to land them in criminal court. Also, if you have a question, feel free to comment below and we'll do our best to reply as soon as we can. Our first topic of the Trump tax is the changes it made to the individual tax laws. I wanted to start out with this topic instead of jumping right into the business or real estate changes, because the individual tax changes apply to everyone. Some of you may have already filed your tax returns and therefore may know some of these rules. For the procrastinators watching, you may want to pay attention. We'll start with some good news for everyone. You should all be enjoying a lower tax rate. Hooray! On average, each tax bracket dropped 2 to 3%. The slide sets forth the tax brackets under the Trump tax. The amount in the parentheses sets forth the income levels that each bracket covers, depending on your filing status. But let's compare these numbers to old tax laws. In 2017, the first tax bracket was 10%. The number remains unchanged under the Trump tax. The second bracket was 15%. The Trump tax dropped this by 3%. The next tax bracket was 25%, then 28%, then 33%, then 35%. You can see that both versions, the old and the new tax, each have a 35% tax bracket. The highest tax bracket under the old law was 39.6%. The new law is 37%. Now let's say you're watching and you make over $600,000. Then you just received a 2% savings, which could amount to over $12,000. The previous slide covered individual earned income, but let's go over the new capital gain rules. Remember, capital gains apply to individual unearned income, meaning investment income. Some basic examples of unearned income would be from sale of stocks, bonds, and property. In more good news, the capital gains rates will remain unchanged at 0%, 15%, and 20%. The rates vary depending on your income level. In addition, the Medicare surcharge rate and the net investment income tax remains unchanged at 0.9% and 3.8%. There were big changes to the standard deduction and personal exemption rules under the Trump tax. The most notable change is that there are no more personal exemptions. Instead, the standard deduction, which is the amount given to every person who files a return, was increased and doubled. Under the old law, single taxpayers received $6,350. Under the new law, they will receive $12,000. Under the old law, head of household taxpayers received $9,350. Under the new law, they will receive $18,000. Under the old law, married taxpayers received $12,700. Under the new, they will receive $24,000. At this point, many people ask me, so what does this all mean? The answer, in my view, is don't have too many kids. For some of you, my boss included, it's too late. Let me explain. Under the old law, a married couple filing jointly with 3 kids would receive $12,700 for their standard deduction and $4,050 for each kid in their household. This means that the married couple will get $34,220 taken off their taxable income. However, under the new law, the same married couple will only get $24,000. Ultimately, a married couple filing jointly with 1 child will essentially break even when comparing the old tax law to the new tax law. However, if that same household has more than 1 child, they are losing money under the new tax law. But depending on their income level, they may also come out ahead since the tax brackets were lowered under the new tax law. Of course, this does not take into account the taxpayer's other deductions and credits. During this portion of the speech, Cameron would have asked you to raise your hand if you had never heard of the kiddie tax. Now, while that seems probably pretty silly in front of your computer screen, I'll take the time to just explain it instead. The kiddie tax is a tax that applies to income, both earned and unearned, by a minor child over a certain amount. The government wants money, even your child's money. Under the old law, the child's income was taxed at their parents' rate. Under the new law, the child's earned income, meaning income earned from a job, is taxed as if the child was a single adult. In addition, their unearned income, meaning their investment income, is taxed at the capital gains rate. For those of you with children who work after school or during the summer, this is a pretty big deal. For those of you without kids, you probably shouldn't care. This next slide here, we have some more bad news. For those of you who used to itemize, you were able to deduct the taxes you paid for your state and local governments or the sales tax that you paid. Under the Trump tax, you still can, but you are severely limited in what you can deduct. Under the new law, you can only deduct $10,000 in state and local taxes. This number includes amounts paid to the tax and taxing authorities, like Missouri or Kansas, local taxing authorities, like Kansas City, and controversially, it also includes property taxes. Let me give you an example to show how big of a deal this is. Let's take our pretend married couple with a combined income of $150,000 per year. If they live in Missouri, they are going to pay the state approximately $9,000 in income taxes. If their home is in Jackson County and is worth $200,000, they are going to pay the county approximately $2,800 in property taxes. Under the old law, they would be able to take an itemized deduction for the full $11,800. Under the new law, they are only allowed to deduct $10,000, and that other $1,800 they spent is lost forever. By my rough calculations, a Jackson County, Missouri resident will be unaffected by this new deduction limit if their home is worth less than $200,000, their combined household income is less than $100,000, and they don't live in Kansas City. Now we get to move on to the new rules regarding the AMT, or Alternative Minimum Tax. I call this the rich tax. For those who are not familiar with AMT, it is a special tax assessed on the wealthy to stop them from using loopholes to avoid paying taxes. In a nutshell, it's another tax rate that applies when you make over a certain amount of money. The good news is that the Trump tax increased the income thresholds for when the AMT applies to people. Under the old law, single taxpayers would get hit with the AMT if their income went above $54,300. Under the new tax law, that amount has increased to $70,300. Under the old tax law, married taxpayers would get hit with the AMT if their income went above $84,500. Under the new tax law, that has increased to $109,400. This means that you can make more money before the government considers you rich and hits you with another tax. Now we'll switch back for you and cover some more good news and talk about the child tax credit. The child tax credit is a tax credit that is given to taxpayers who have children under the age of 17. For 2017, the credit is typically $1,000 per child, but the $1,000 amount can be reduced the more income you make. Under the Trump tax, everyone can now get $2,000 per child that is under the age of 17. So the child tax credit amount is doubled for everyone with kids. In more good news, taxpayers can now receive a $500 non-refundable credit, meaning that credit will reduce your taxes, but it will not generate a refund for you, for each person who is not your child, but is your dependent. A common dependent that is not a person's child would be an elderly parent that a taxpayer is supporting. However, in order to take the credit, you must have a valid Social Security number for each dependent. No more claiming dead people or those imaginary friends. In case you hadn't caught on to the rotating scheme of good and bad news, we are on the bad news again now. This topic involves other itemized deductions, but there is a silver lining. The silver lining is that taxpayers can still deduct medical expenses, and now you can deduct even more of them. Under the old law, you could only deduct medical expenses that exceeded 10% of your income. Under the new law, you can deduct medical expenses that exceed 7.5% of your income. This means that the threshold bar has been lowered so that more people can deduct more medical expenses. But while that silver lining was nice, here comes the bad news. All of that itemized deductions that were subject to the 2% limit were eliminated. I don't expect you to know all of them, or any of them really, but here are a few deductions that are going away under the new law. Unreimbursed employee business expenses, union dues, expenses for looking for a new job, legal fees related to your job, tools and supplies for your work clothes and uniforms, investment fees, legal and tax advice fees for your investments, safety deposit box fees, tax preparation fees, attorney and accounting fees to fight the IRS, and hobby expenses. But now let's talk about the Pease limitation, named after the late Congressman Donald Pease. The Pease limitation is a rule that states that your total itemized deductions are reduced by 3% for every dollar of taxable income that exceeds a certain amount. For 2017, this amount was $254,200 for single taxpayers and $305,050 for married taxpayers. Under the new law, the Pease limitation has been suspended, and therefore everyone can maximize their item deductions regardless of income. Alright, now let's talk about home ownership and how it is affected by the new tax law. The first thing you need to know is that people with new mansions can no longer deduct their mortgage interest. Under the new tax law, interest on mortgages originated after December 14, 2017 are limited to the first $750,000 borrowed. Any mortgage interest paid on amounts over $750,000 are non-deductible. The second thing you need to know is that home equity loans, regardless of when it was opened or the amount, are non-deductible unless all of the borrowed funds were used to improve your home. The third thing you need to know is that you can still sell your house for a tax-free gain up to $250,000 for single taxpayers or $500,000 for married taxpayers. Under previous versions of Trump tax, the home sale exclusion would have been limited to once every 5 years. However, that limit was not signed into the actual Trump tax law. The next slide dives into a hot and hated topic, healthcare. The good news is that there is no longer a penalty for being without health insurance. The bad news is that it didn't start until 2019. Therefore, you will still be penalized for not having minimal essential health insurance in 2018. The maximum penalty for 2017 and 2018 is the higher of 1. 2.5% of the yearly household income, or 2. $695 per adult and $347.50 per child under age 18. More bad news is for the members of Congress who happen to be watching. You can no longer deduct your living expenses on your tax return. Sadly, you are now like the rest of us in that regard. For those of you who donate lots of money to charity, the Trump tax allows you to give even more. Under the old law, you were only allowed to deduct 50% of your income that you donate. Under the new law, you can deduct up to 60% of your income that you donate. In addition, you can no longer deduct any donations made for university athletic seating rates. Also, in regards to personal losses such as fire, tornado, and theft losses, you can no longer deduct those expenses unless the losses are attributable to a presidentially declared disaster zone. For some good news on individual provisions, the gambling loss deduction has been loosened. The general rule is that a person can deduct their gambling losses to the extent of their gambling winnings. The new tax law broadens the definition of a gambling loss to include other expenses incurred in gambling, such as travel back and forth from a casino or racetrack. Kansas, on the other hand, does not allow you to deduct your gambling losses. So now for your bad news, for all family law attorneys watching. If you did not know already, the new tax law exempts alimony payments from being taxable and included in income. But in bad news, the new tax law also stops a taxpayer from deducting the alimony payments that they make to their ex-spouse. These new rules apply to all divorces and separation agreements that are executed after December 31st, 2018. But this still holds true, it's better to receive alimony than pay alimony. Speaking of families, the new tax law broadens the allowable use of 529 plans. A Section 529 plan is typically a state-sponsored investment account that is set aside for a specific beneficiary to use the funds for qualified education expenses. The benefit of these plans is that any accruals of the plan are tax-free and contributions to the plan are tax-deductible. The catch is that the money must be used for qualified education expenses. Under the new law, the money can now be used for elementary and high school expenses as well. Under the old law, the money could only be used for college. The other catch is that the funds distributed from the plans must be $10,000 or less per year per beneficiary. As previously mentioned, under the new law, there will no longer be a tax deduction for people who pay alimony. This applies to any and all divorces or marital agreements that are executed in 2019. In addition, modification agreements will be affected by this new rule unless they specifically state that the new rules shall not apply to them. In addition, under the new law, taxpayers are no longer allowed to recharacterize a conversion from a traditional 401k, 403b, IRA, SEP, or simple to a Roth IRA. Under the old law, a taxpayer was able to recharacterize the contribution if the trustee is informed that the contribution, plus any earnings, be transferred to a Roth IRA by the due date of your tax return. The new tax law prohibits this sort of recharacterization beginning in 2018. Speaking of retirement plans, the new tax law extends the rollover period for certain plan loan offset amounts from 60 days to the due date of the tax return for the year in which the plan loan offset occurs. Alright, well we just went through the changes under the new tax law that affects individual taxpayers. Let's switch gears a little bit and discuss the new tax law changes that affect businesses. First, the new tax law enacts a flat 21% tax rate. The new tax law removes the graduated tax brackets. To give you some numbers to compare, in 2017, the lowest corporate tax rate was 15%, and the highest was 35%. Of course, this does not affect pass-through entities such as partnerships or S-corps. Second, the new tax law repeals the Section 199 domestic manufacturers deduction. This deduction allowed manufacturing businesses, including construction and software companies, that made items in the U.S. to deduct 3% of their income. Third, the new tax law provides a business credit for employers that provide paid leave under the Family Medical and Leave Act, known as FMLA. Currently, the law does not require employers to compensate their employees while on FMLA. However, the new tax law provides a business credit between 12.5% and 25% to employers that pay their employees at least 50% of their normal wages while the employee is on FMLA. Fourth, the new tax law cut taxes on beer, wine, and distilled spirits. Under the old tax, brewers paid $7 per barrel on the first 60,000 barrels produced per year, and $18 per barrel in excess of 60,000 barrels. Under the new tax law, that tax dropped to $3.50 per barrel on the first 60,000 barrels, and $16 per barrel in excess of 60,000 barrels. Hopefully, this drastic drop in the tax rates will mean lower prices on alcohol for everyone in the country. We are going to be spending quite some time on the next topic because it may be one of the biggest changes to businesses under the new tax law. If you have not yet heard, the new tax law provides a 20% deduction on income for business owners. That is probably what you have heard on the news and around the water cooler, but let's dive into the details and see whether the new law will affect you. The qualified business income deduction, which is the 20% deduction for business owners, applies to sole proprietors, partners in partnerships, shareholders in S-corps, and trusts and estates. Sounds good thus far, right? Seems to cover basically everyone here. Unfortunately, this deduction is quite complicated in that it has a lot of rules and exclusions. One of those rules is that it is not available to C corporations. Another one of those rules is that the deduction becomes limited based upon taxpayers' taxable income. For instance, a single taxpayer with over $157,000 in taxable income will not be able to take full advantage of this deduction. The same can be said for married taxpayers with over $315,000 in taxable income. Another one of those rules is that the 20% deduction cannot exceed the partner, shareholder, or individual's adjusted taxable income. The long way of saying this is that the deduction cannot exceed your taxable income for the year over your net capital gain plus aggregate qualified cooperative dividends. The short way of saying this is that the deduction is taken below the line. The deduction will reduce your taxable income, but it will not give rise to net operating loss. Another rule is that the 20% deduction is only available for businesses that have qualified business income. Qualified business income is defined as the net amount of income, gain, deductions, and losses with respect to your trade or business. The income must come from domestic sources, including Puerto Rico. The income cannot be investment income, dividends, capital gains, or commodity gains. Qualified business income also does not include any amount paid by an S corporation to its owners or shareholders if it is considered reasonable compensation. Qualified business income also does not include any guaranteed payments made by a partnership to a partner for services provided to the partnership. Another rule is that the 20% deduction is only available to a qualified trade or business. This is the part that is going to make a lot of people watching kind of upset. A qualified trade or business is defined as any sole proprietorship, partnership, S corporation, or trust and estate that is not engaged in a specified service or trade business. Specifically, the 20% deduction is not available to businesses that are engaged in the fields of health, law, consulting, athletics, financial service, brokerage service, or any trade or business where the principal asset is skill of its owner or employees. Obviously, anyone watching that is in the legal field will not benefit from the 20% deduction. However, since the definition of a qualified trade or business excludes any business that relies on the skill of its owner, it's hard to imagine that any service related to business can really qualify for this deduction. However, for some reason, engineers and architects are not included in the list of non-qualified businesses, and therefore engineers and architects will benefit from the 20% deduction. The list above on this slide is just the list of business categories that are not eligible for the QBI deduction. Now, if you happen to be one of the few to pass the rigid definition of a qualified trade or business, you still have to be engaged in a business activity. Unfortunately, the new law does not specify how it defines business activity, so we are left using existing authorities to make this determination. Section 162 of the Internal Revenue Code states that a taxpayer is involved in a business activity as long as the business is regular, continuous, and substantial. This definition casts a very large net to encapsulate activities that will be treated and considered as business-related activity. Now, for any people that are watching that have rental property that they rent out for a small profit and would like to argue that this is more of a hobby than a business activity, there is case law that states even leasing a single piece of rental property, it is substantially enough to be considered business activity. However, being considered a business activity only gets you half the way to obtaining that 20% deduction. If you have managed to jump through all of those hoops and you do qualify for the 20% deduction, it still has its limits. For instance, the deduction is limited to the greater 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% of qualified property. qualified property is tangible property subject to depreciation under 167 of the Internal Revenue Code. However, the deduction cannot exceed your taxable income for the year over your net capital gain plus aggregate qualified cooperative dividends. What does this mean for you exactly? In a large nutshell, the deduction cannot generate a loss for you. To get your head swimming even further, the definition of qualified property is quite lengthy. We're going to go to it here on the next slide. Qualified property is the unadjusted basis of all tangible property held by a qualified trade or business, not a C corporation, which is used to generate qualified business income for trade or business. What does this mean exactly? It means that the qualified property is essentially any property that you can depreciate. This so happens to benefit the real estate industry once more because without this definition, real estate investment groups do not pay out wages. Instead, they distribute dividends. This means that real estate investment groups and its shareholders or owners will qualify for the 20% deduction under the new tax law. If you are still managing to pay attention, you might be asking yourself, so what does all this mean? Well, the definitions that we just went over basically means that investors of real estate will receive a 20% deduction in the taxable income they receive from their real estate investment group. But, for everyone else watching, you won't get that deduction if you qualify for any of the other corporations that were mentioned. Now, you may be asking yourself again, why would the law benefit real estate investors but not attorneys? The answer is similar to the age-old question of how many licks does it take to get to the center of the Tootsie Pop? The answer? The world may never know. This next slide here talks about what sort of property can be included in the definition of a qualified property. It simply states that the qualified property is any property that can be depreciated. But if you own property that has already exhausted all of its depreciation, then that piece of property no longer fits within the definition of qualified property and therefore can no longer be used in the calculation in determining the 20% deduction. I could dive into this even further, but for most people, simply mentioning the word depreciation puts them to sleep. So if you have any questions in the area, feel free to comment below or send me an email. For the final slide on the 20% deduction, let's assume that you have qualified business, you have qualified property, that you are in the correct practice area to meet all of the requirements of the 20% deduction. But even with all of that, you don't meet the deduction limitations regarding the 50% or the 25% W-2 wages threshold. Well, if you are in that boat, there is some good news for you. Single taxpayers with an income of less than $157,000 or joint taxpayers with an income of less than $315,000 can qualify for the 20% deduction without having to consider the calculations on either the 50% or the 25% W-2 wages. Instead, the government will consider you a low-income taxpayer and will give you a pass on the W-2 calculation requirement because you are deemed to be too poor to be able to pass this test. So, this exception of the W-2 wages calculation is somewhat insulting, but as long as you're okay with being insulted, you may qualify for that deduction. However, if you do make more than $157,000 for single taxpayers or $315,000 for married taxpayers, then your deduction will be phased out. Phased out means gradually reduced or limited. Eventually, you will earn over a certain amount of money, you will no longer be considered too poor by the government, and then you will be subject to the 50% or 25% calculations test on your W-2 wages. Well, now that I'm tired of talking about it and you're tired of listening, let's move on from that 20% deduction. We'll switch to a different topic. Let's talk about what the new tax law has done to the deduction of excess business losses. Just as a primer, a business incurs a loss when it spends more than it makes. Sometimes, depending on the loss, that loss can be carried forward to future tax years to offset future gains. For example, under the old law, we have a Tim. Tim is one-man show that is a custom paint company that does custom paint jobs for Harley. When things are going well, Tim's business makes a small profit, considering its high expenses, but it still makes a profit. Unfortunately, sales are down at Harley, and they are closing the Harley plant. Therefore, the business has had a bad year. A whole bunch of custom paint goes bad because Tim bought in bulk, and now it's not being used, and the business spends $300,000 more than what they made in the year. In this case, the business has a loss of $300,000. However, the business may be able to treat the loss as a net operating loss and carry it forward to the next tax year. So if the business makes a profit in the following year, it may also be able to use its $300,000 net operating loss to reduce some of its taxable income. Also, Tim might have other income, such as retirement distribution or wages from another job. Tim could use the $300,000 to reduce, thereby reducing his overall tax burden for the year. Alright, Remember this example because we're going to see how the new tax law changes things. The new law, a non-corporate business, meaning this rule applies to individuals, estates, and trusts, is limited on the amount of loss it is able to take every year. The loss limit that the business is allowed to take is $250,000 for single taxpayers and $500,000 for joint taxpayers. If you want to get super technical, the limit is gross business income or gain plus $250,000 or $500,000 for joint returns. This limits the amount of business losses that were previously usable against all other income without any limits, including salary, fees, interest, dividends, and capital gains. Any excess business loss is converted to a net operating loss carryover to the next year. Partners and S-Corp shareholders use their net trade or business and rental amounts as reported on their K-1s. It is important to know that this rule applies after the passive loss rules. Therefore, to the extent of net non-passive losses, real estate professionals and other individuals, estates, and trusts are likely to be affected by this rule. So what does this mean for Tim in our example? Well, if you recall, Tim's business had a bad year and he lost $300,000. Under the new tax law, since Tim is a single guy, Tim is only allowed to deduct $250,000 of business loss. So the new law hurts Tim in this aspect. All is not lost. Tim can use the remaining $50,000 loss as a net operating loss and use it to offset the next year's income. But the limit on how much Tim can offset the next year's income is 80% of his taxable income. Law also sets some new limits on how it treats excess business losses. First, the limit applies to all personal and pass-through losses for the year. This means that loss rules apply even if Tim had a partnership with Daryl, and both Tim and Daryl received K-1s from the partnership. Second, this excess business loss rule goes into effect January 1, 2018, and does not expire until December 31, 2025. So what are some tips you can do to minimize your business losses so that you are not affected by this business excess rule? One thing you might try to do is avoid taking bonus depreciation or Section 179 expensing. Another thing you might try is to donate leveraged property to a charity or as an investment into a corporation. Another thing you might want to try is to reinvest money in a like-kind exchange or an involuntary conversion to trigger a gain. There are plenty of things that businesses might want to do to avoid taking huge loss and falling victim to this excess business loss rule. Now we're going to move on to accounting method provisions. The cash method of accounting permits a business eligible to use it to recognize income and deduct expenses at the time the associated cash is received or paid. For many businesses, the cash method provides substantial tax benefits over the accrual method of accounting that is otherwise required. Businesses that utilize the accrual method generally recognize income earlier than the time revenue is due, paid, or earned through required performance. Since most businesses transact business with clientele prior to the time cash is collected, revenue under the accrual method must be recognized sooner than the cash method would stipulate. Any taxpayer, including a C corporation, is eligible to use the cash method, subject to the new gross receipts test, even if the production, purchase, or sale of inventory is an income-producing factor for the business. This receipts test is much more generous than any of the tests provided under the Pre-Tax Act law. The manner in which the new gross receipts test is determined has not changed from the Pre-Tax Act law. Some tips regarding tax shelters. They are somewhat complicated, so we will skip them for this lecture. Businesses meeting the $250 million test are also completely exempt from the uniform capitalization rules under Section 263A. Changes to adopt the cash method pursuant to the new rules will be treated as voluntary change in method of accounting and will permit taxpayers to include Section 481A adjustments in the year of change. Either of the new inventory provisions can be applied with or without the new cash method of accounting provisions. Changes to adopt the inventory provisions of the new rules will be treated as voluntary change in method of accounting and will permit taxpayers to include Section 481A adjustments in the year of change. Any taxpayer meeting the aforementioned $25 million gross receipt test and is also not a tax shelter is no longer required to maintain inventories in accordance with Section 471 and instead may treat inventories as non-incidental materials and supplies. We're going to move on to depreciation provisions. This property now qualifies as long as it is the taxpayer's first use of the property. This slide here gives you an example of how you would benefit under the new law versus the old law if you acquired existing assets after September 27, 2017. Real property trades or businesses may elect out of the business interest deduction limitation. However, if it makes such an election, it must elect to depreciate any of its non-residential real property, residential rental property, and qualified improvement property using ADS. The TCJA's legislative authority intended to allow qualified improvement property to be eligible for this bonus depreciation, but the tax code does not provide this. If the tax code is not fixed by technical corrections, the depreciation life of such property is 39 years, instead of 15 years as intended. From there, if there was a binding contract with a GC to build the property prior to September 27, 2017, then only 50% bonus would apply. The bonus depreciation would not apply for used property. A Section 179 deduction was increased to $1 million per year, and phase-outs for qualifying property exceeding $2.5 million. It also applies to property used for lodging purposes, i.e. where you sleep, and other accommodations such as hotels, motels, and dormitories, to qualified improvement property and tangible personal property used in any trade or business. As a result of the bonus depreciation provisions, the Section 179 provisions are made largely irrelevant. However, certain real property improvements not eligible for bonus depreciation are eligible under Section 179. Moving on to estate, trust, and gift provisions. The basic exclusion amount for estate and gift taxes was roughly doubled, which has been indexed for inflation. Estimates project that for 2019, the basic exclusion amounts will be $11.18 million for individuals and a combined $22.36 million for married persons. As a result of the exclusion amounts, the effective rate for taxable estates and taxable gifts is 37% for 2018 through 2025. These rates and brackets expire at the conclusion of 2025. Alright, now that we've gone over all of that exciting stuff, let's get to the really exciting stuff. With the time we have left, we're going to review some stupid things that people have done recently that have gotten them into some trouble. On April 4th, 2017, in Tampa, Florida, Walter Drakeford of Santa Monica, California, was sentenced to 24 months in prison for attempting to interfere with the administration of internal revenue laws. Between September 2006 and March 2009, Drakeford and another individual falsely purported to own the rights to landfill methane credits. They marketed the purported credits to a network of tax return preparers for use on individual taxpayers' tax returns, despite knowing that the credits were non-existent and were not available to be claimed by the individual taxpayers. The tax return preparers advised their individual taxpayer clients to claim the credits on their tax returns. If an individual taxpayer received the tax refund as a result of the landfill methane credit claimed, they were obligated to remit a substantial portion of that refund, frequently as much as 80%, to Drakeford and others. Drakeford presented false and fraudulent documentation to the IRS and presented fraudulent and false amended tax returns that claimed purported dry hole expenses. Drakeford and others provided the tax return preparers a formula by which to calculate the amounts of the dry hole expenses to be claimed by the individual taxpayers. The formula was designed to fraudulently eliminate the individual taxpayer's debt to the IRS based on the disallowance of the false and fraudulent landfill methane credits. The total amount of false and fraudulent credits claimed in this case was estimated to be $4,211,757, a substantial amount of which has been recovered from the individual taxpayers. On March 14, 2017, in Cleveland, Ohio, Dennis Dean Miller of Millersburg was sentenced to 26 months in prison and ordered to pay $132,000 in restitution. Miller falsely reported that financial institutions had withheld large amounts of federal income tax on income that did not exist in reality. He falsely filed for tax refunds of $1,121,000 for tax years 2006 through 2011. To continue, on February 10, 2017, in Alexandria, Virginia, Dan Horsky, formerly of Rochester, New York, was sentenced to 7 months in prison, 1 year of supervised release, and ordered to pay restitution in the amount of $250,000 for conspiring to defraud the United States and to submit a false expatriation statement to the Internal Revenue Service. Horsky paid a civil penalty of $100 million to the U.S. Treasury for failing to file and filing false foreign bank and financial accounts. Beginning in approximately 1995, Horsky invented in numerous startup companies, virtually all of which failed. One investment in a business referred to as Company A, however, succeeded spectacularly. In 2000, Horsky transferred his investments into a nominee account in the name of Horsky Holdings at an offshore bank in Zurich, Switzerland, the Swiss bank, to conceal his financial transactions and accounts from the IRS and the U.S. Treasury Department. Horsky filed a fraudulent 2008 tax return that underreported his income by more than $40 million and disclosed approximately $7 million of his gain from sale. By 2015, Horsky's offshore holdings hidden from the IRS exceeded $220 million. Tax evasion scheme ended in 2015 when IRS special agents confronted him regarding his concealment of his foreign financial accounts. Horsky willfully filed fraudulent federal income tax returns that failed to report his income from and beneficial interest in and control over his foreign financial accounts. In addition, Horsky failed to file reports of foreign bank and financial accounts up and through 2011, and also filed fraudulent 2012 and 2013 FBARs. In total, in a 15-year tax evasion scheme, Horsky evaded more than $18 million in income and gift tax liabilities. On March 24, 2017, in Houston, Texas, Cedric Keith Oliphant, a local tax return preparer, was sentenced to 36 months in prison for a second time for preparing false tax returns and obstructing the IRS. Oliphant will also serve 1 year of supervised release and pay restitution of $400,000 to the IRS. Oliphant was previously sentenced to 33 months in prison on charges he prepared dozens of false 2006 to 2008 client tax returns through Oliphant Tax Services. He was released on bond, in that case, under a condition that he had no further involvement in the preparation of tax returns other than his own. However, Oliphant resumed tax return preparation and continued to claim the same false deductions for unsuspecting clients while awaiting sentencing in the other case. As part of the scheme, Oliphant changed the name of his business to Tax Services to make it appear he had stopped preparing client tax returns and that someone else was the owner of his tax preparation business. Oliphant allegedly attributed the fees to the nominal owner of his tax office, but manipulated those tax returns to make it appear that the tax office had produced almost no taxable income. Oliphant established a series of bank accounts in the names of others in order to deposit the fees into these accounts. Transferred those fees through these intermediate accounts to his accounts in his own name. The scheme enabled Oliphant to conceal his personal use of the fees generated by the business during the course of the prosecution on the first case, according to the plea agreement. Through this scheme, Oliphant generated $2 million in fees and a total loss of the IRS of another $400,000. Oliphant's plea agreement requires that he surrender approximately $205,000 in bank accounts linked to the scheme, his personal residence, and 3 automobiles valued at $32,600 as restitution to the IRS in both cases. November 17, 2016, in St. Paul, Minnesota, Mark Arlen Hammerschmidt and his wife, Ornella Angelina Hammerschmidt of Prior Lake, Minnesota, were sentenced to 135 months and 48 months in prison, respectively. In addition, Mark Hammerschmidt was ordered to pay $1,832,986 in restitution, and Ornelia Hammerschmidt was ordered to pay $45,365 in restitution for their roles in orchestrating a multi-million-dollar tax fraud scheme. From January 2011 through February 2013, Mark and Ornelia Hammerschmidt operated an immigration and tax preparation business called American Group, located in Shakopee, Minnesota and Winter Garden, Florida, which they utilized to prepare and file more than 1,000 fraudulent federal income tax returns. The defendants attracted customers to American Group by misrepresenting their professional credentials and certifications. Most notably, Ornelia Hammerschmidt falsely represented herself as a licensed immigration attorney. As part of the scheme, the defendants attempted to conceal their involvement as fraudulent return preparers by intentionally not signing the tax returns on the part of the form meant to be signed by paid preparers. The defendants also falsely reported their business addresses and bank accounts controlled by them as the addresses and bank accounts of the taxpayer clients. In connection with this part of the scheme, the defendants sought approximately $200,000 in fraudulent tax refund payments. Many of the defendants' clients were non- or limited English speakers who relied on the defendants. The false returns filed on behalf of the taxpayer clients caused substantial harm to them, both in terms of problems with the IRS and problems with immigration status. In addition, tax returns were filed by Mark Hammerschmidt, who obtained the personal identification information of hundreds of Guatemalan citizens. Mark Hammerschmidt then prepared and filed with the IRS applications for individual taxpayer identification numbers and the names of the Guatemalan citizens. Once he obtained them, Mark Hammerschmidt filed multiple years' worth of false tax returns in the Guatemalan citizens' names, seeking refunds based on false information. Mark Hammerschmidt also used them to file false Minnesota state income returns. In connection with this part of the scheme, the defendant sought approximately $1.8 million in tax refunds based on the fraudulent tax returns he filed. On December 21, 2016, in Oklahoma City, Oklahoma, Burundi Nichelle Lowles of Smyrna, Georgia, pleaded guilty to submitting a false income tax return to the IRS and was sentenced to 33 months in prison. In addition, Lowles was to serve 1 year of supervised release and pay $263,665 in restitution to the IRS, as well as to her victims. Lowles, a former resident of Oklahoma City, admitted to filing a false income tax return for the 2009 calendar year that contained a fabricated W-2 listing $12,000 in wages and $2,000 in withholding, as well as a false Form 1040 Schedule C that claimed $165 in expenses for a cleaning business where no such business actually existed. On January 25, 2017, in Jefferson City, Missouri, David Lee Keithley of Columbia was sentenced to 24 months in prison and ordered to pay $291,041 in restitution to his victims. Keithley owned and operated Keithley & Associates, offering tax preparation and payroll tax services in Columbia. Keithley was hired by his clients to prepare proper tax returns as well as send the tax deposits to the government. After accepting funds from his clients, Keithley used the money for his own personal benefit instead of paying his clients' taxes. When the clients contacted Keithley after receiving letters from the IRS indicating these returns had not been filed or taxes had not been paid, he told his clients he would contact the IRS to correct it. The total amount of these misappropriated funds is $120,354. Keithley also admitted that he willfully failed to file federal income tax returns for the tax years 2009 through 2013. On January 24, 2017, in Boise, Idaho, Mary Gallen of Twins Falls, Idaho, was sentenced to 24 months in prison, 3 years of supervised release, and ordered to forfeit and pay restitution of $336,926 to the IRS. From around 2006, Gallen owned and operated Gallen Accounting in Twins Falls and prepared tax returns for clients. In about 2013 and through about 2015, Gallen conspired to defraud the IRS by claiming education credits through the American Opportunity Credit on clients' taxes returns, knowing that they did not qualify to claim the credit. Gallen and her co-conspirators prepared 187 tax returns for 165 taxpayer clients, claiming $342,901 in education credits, with a tax loss of $336,926. For some taxpayer clients, Gallen prepared tax returns directing the IRS to deposit refunds belonging to taxpayer clients into personal bank accounts belonging to Gallen and her co-conspirators. In total, Gallen received direct deposits of taxpayer client refunds of $219,490. On January 23, 2017, in Oklahoma City, Oklahoma, LaQuinta Q. Fisher of Lawton was sentenced to 18 months in prison, 3 years of supervised release, and ordered to pay $130,955 in restitution to the IRS for an earned income credit tax fraud scheme. Fisher was a self-taught tax returner preparer who worked in Lawton area for tax years 2010 through 2014. She recruited clients by word of mouth and distribution of flyers. Fisher advised her clients that all she needed was a dependent child in order to receive a refund from the government. She then falsified returns for clients by adding fictitious income to increase the earned income credit and by adding false dependents to maximize the EIC, which resulted in false refund claims. Fisher prepared and submitted the returns for her clients electronically to the IRS. Now that we've wrapped up all of that fun information for you, feel free to comment below any questions, comments, or anything else we can help you out with.